What's up, guys? It's Cash Flow Cart. Today is Tuesday, October 29th, and I have a very exciting and special video. Today, we are going to go over 3 common mistakes that investors make. If you're new to the channel, I'm a dividend growth investor. I invest in undervalued dividend paying stocks, and typically I try to find stocks that continue to grow those dividends year after year. With that being said, guys, I've been investing now for about 6+ years, and there's definitely been a lot of mistakes and lessons for me to learn from. Actually, when I wanted to do this video idea, I I was like, how am I going to narrow it down to just 3 examples? But I think I've picked 3 good real life examples that I've encountered during my journey, and we're going to dig into those today. So, real fast, guys, the portfolio value is sitting at $67,706. Um, and like I said, this is a dividend portfolio. It is estimated to pay me $2,692 over the next 12 months, guys. Okay, so in November, that is my smallest quarter, I will earn $112 in dividends. Okay, guys, let's get into it. First up, the number one mistake I see newer dividend investors make, and not just newer investors, but this is a fairly recent mistake from me. And like I said, I've been doing this a while. It's going to be building positions out too fast and not really taking what the market gives you or taking your time to lock in the best cost basis you can on a position. Guys, the example I will be using to illustrate this point is Realty Income Corporation, ticker symbol O. This is the only stock we're going to go through today that I currently have in my portfolio. So I have 215 shares, and my average price on Realty Income is $65.26, guys. That puts me at an unrealized loss on it of $968. Let's talk about how I could have approached building this position better. Okay, so we will see I've got these green tags. They mark where I've traded as well as what price I got filled at on that day. So I started building this position in, I guess, September 2022. It is now obviously October 24. So I've had this position on for, just over 2 years now. And I kind of want to explain where I went wrong with this one. Okay, so in September 2022, I'd say that's really when I, fully committed to this dividend growth game. Dividend growth investing had always been kind of my favorite style of investing throughout the years, but obviously I was kind of in this mode of, trying different things and doing too much, which we will dive into later. So in September 2022, I spent like 1 or 2 weeks kind of going through, all my assets, trying to consolidate, trying to see what positions I wanted to leave on, what positions I wanted to add. And what I would say is I really brought the portfolio to a much leaner place. I think at this time, I ended up with only 6 or 7 positions after going from having, a multitude of positions along with different investing styles. Okay, so I get the capital, I kind of make my plan for what I want to do with the capital, and rather than being patient, being willing to sit on some cash, have some cash on the sideline, I get a little bit like trigger happy, I would say, on Realty Income, and I buy 125 shares at $67 and change. Okay, I knew this was a position I wanted. And with that being said, I kind of ignored valuation metrics. I kind of ignored what the technicals were telling me. And I went ahead and pulled the trigger, to the tune of, let's see what it would be, 125 times 67, whatever, to the tune of $8,375. So I built this position out a little bit too fast, and it's kind of left me in a place where I have the position on, but my cost basis as well as how many shares I have, it's not as attractive as it could be, and it's not generating as much dividend income as it should be. Does that make sense? So if I would have been a little more patient with this one, and I would have kind of dipped my toes in with a smaller, I guess, original buy of Realty Income, I would have then had more capital on the sidelines and really been able to build out the position more efficiently throughout this dip. Okay, so that's my first takeaway. That's the first lesson, I guess. The first mistake we're going to cover today is, I want to say, don't kind of get blindsided by, I want this stock in my portfolio, I'm going to throw patience out the door. Okay, so I did continue to build the position out, but I could have done a much better job of locking in more shares as it continued to fall. Okay, does that make sense? Like we see here, I only picked up one share at $55. I picked up one at 46, a couple at 50, a few at 60. But my most expensive purchase was that original tranche at 67. Okay, and that's kind of led me to not have the most attractive cost basis on it. Okay, so great position. I'm going to keep the stock in the portfolio, but I could have done a little better, being patient. Okay, so guys, that's mistake number one. Let's get into mistake number two. Like I said, this one's going to be from a position that's no longer in the portfolio today, but it's definitely one that I think about, definitely one I could have handled better, and probably something I still should have in the portfolio. So let's get into it. It's going to be AbbVie, ticker ABBV. As you guys know, this is a pharmaceutical company, and I will kind of try to, I guess, recall my whole thought process through this one. Okay, so like I said, don't have any shares of this, but we will go through it, and we will, hopefully find some good lessons. Okay, so for this one, I started building the position in 2019, so that would have been when I was a junior in high school. I bought 2 shares of AbbVie at $81.62. I can kind of remember my thought process at this time. I had seen AbbVie kind of in this, I guess, descending channel or falling wedge, whatever we want to call it. And then I had seen it break out, and I thought, okay, AbbVie's undervalued. Now is my time to add it to the portfolio. And kind of the reason why AbbVie fell and pulled back in the first place was because they had a patent expiring on the drug Humira. Okay, so it basically led the market to overreact to this news, this patent expiration, and it led AbbVie to overcorrect. I did a great job recognizing that opportunity and going ahead buying 2 shares. Obviously in high school, I did not have, I guess, the type of money to build positions I have now. So, 2 shares, it is what it is. And then I saw AbbVie double bottom, and I went ahead and added 1 more share at 91. I'm not going to get caught up on the quantity, just kind of the lesson here. So I had done my job. I had locked in kind of the position I wanted. And then what happens, guys? I was correct. Okay. I locked in, a very attractive cost basis on AbbVie. I saw it as undervalued. I saw that market overreaction. And when it did go ahead and come back up towards, what are we doing here? And then AbbVie did come back to all-time highs, okay? Like I had kind of suspected. It was undervalued. I, anticipated it would come back to more of a fair value, and it did that. In that situation, I had my position built out. Again, I know it's 3 shares, but, I think we get the gist. I had my position built out, and it was a great dividend stock for my portfolio. Rather than leaving it on, continuing to enjoy that dividend growth, I saw AbbVie come back to all-time highs, and I just took the position off. I just saw, I guess, probably the open profits, and I kind of changed my mindset. Okay, I wasn't locked in really in my head as being a dividend growth investor. So maybe this is a situation where I could have trimmed a few shares, but there's no reason why I should have liquidated this position. Okay? In this game, you kind of have to learn, if you're doing it right, you're doing your due diligence, and you have convictions in the stocks you're buying, you almost expect to get to a point where you're profitable on plays. You have unrealized profits, you have growing dividend income. That's the whole point of this game. I don't know why then I would change my mindset and go ahead and realize, whatever it is, a 20-25% profit. Okay. So I switched up kind of what type of investor I was, what type of play this was, just because I saw those unrealized profits. And that's a big mistake. Definitely one that cost me. And AbbVie, I could have left this on, continued building the position, but instead, I have 0 shares. I've missed out on some phenomenal dividend growth from these guys. Okay, so that's mistake number 2. That's lesson number 2, is liquidating winners because of unrealized profits. I mean, it's easy to do, especially early on in the journey when you're not so used to seeing, great trades, great winners. You're still kind of figuring out your system, and it's easy to get blinded by that. With that being said, there is appropriate times to trim positions, and I've spoke a lot on that with Apple as well as Microsoft. However, I've also talked about, I trimmed these positions because I saw some overvaluation. But if I have a dividend stock in my portfolio and they continue to grow the dividend, they continue to, maintain that wide moat rating I look for, I don't think I ever really want to liquidate positions. Okay. So, that's mistake number 2, liquidating for essentially no reason other than profits. All right, guys, moving on. And this one is going to be, probably unexpected from you guys because, I present myself as a dividend growth investor. That is what I do fully now. Since I've had the YouTube channel, I've started it just for dividend growth investing. That's kind of my lane. That's how I see value. But like I said, guys, it's taken mistakes. It's taken years to kind of understand what works best for me, why this works best for me, and kind of what my risk tolerance is for this game. But, bit of a rant there. Mistake number 3 is going to be mixing too many investment styles in one portfolio. And the ticker we are going to use to demonstrate this point is none other than Palantir Technologies. That's ticker PLTR. Let's go ahead and look at the chart and I guess take a trip down memory lane. So, Palantir Technologies, if you don't know, it's a cyber security company. They have two segments. One segment is with government contracts and defense, and then the other segment is kind of business to business operations management in using machine learning and AI to essentially, make operations in a business go smoother. Decision making, assisted operational management, that type of thing. Okay. That's kind of what I understand about it. I obviously don't do too much due diligence on it now as a dividend investor, but just from when I was a shareholder, guys. So I had kind of gotten fired up about Palantir Technologies, PLTR. I'm not going to dig into the fundamentals because it was more of a speculation type investment for me. Um, it was more of something that I had a story built in my mind, and this was speculative trading. And the problem was, I kind of mixed this speculation type of trading in with my dividend investing portfolio, and it was really hard to get a sense of, okay, now what is my stock market portfolio? What am I really doing here? Um, how am I ever going to outperform the S&P 500 if I'm so focused on doing multiple things in one place? Okay, because maybe my dividend stocks were doing well, and then I've got something like this, a speculation play that I can't really wrap my head around kind of the time frame for this to do better. Okay, and I continued building out the position, but you know, in hindsight, it was kind of one of these things where I was gambling. I was hoping that this one would turn immensely profitable, give me, exponential returns in the portfolio. And I kind of let some emotions get involved on this position because I was a dividend investor. So, mistake number three. Hang on one second. Mistake number three is going to be mixing too many investment styles in one portfolio. If we look at the chart here, guys, I guess looking back, it's like, oh, I could have left Palantir on. Now it's, making all time highs and it's kind of making a huge run. Okay, that's easy to say now, but if you're mixing multiple styles at once, you're not going to be able to do the required due diligence. You're not going to have conviction in your positions. And ultimately, it's going to cost you and it's going to lead to market underperformance, guys. So that's mistake number three, doing too much, guys. I urge you to kind of pick a style of investing that resonates well with you and try to learn as much about it as you can. And that's going to allow you to outperform as you become, more proficient in that one style of investing. Okay. I'm not saying, never try other things, never learn from different situations. All I'm saying is it's going to be much easier to reach profitability and outperformance if you're kind of focused on one game. And I will say, if you are newer to investing, dividend growth investing is kind of a great place to learn and develop your skills and the way you see value. Okay, it's worked really well for me personally, and obviously everyone has different risk tolerances and sees value in different ways, but dividend growth investing is what has really, really changed the game for me. So, guys, that's what I cover on this channel. And if you are new here, please subscribe. I appreciate all the support we've gotten on the channel lately, guys. It's been amazing. We are over 500 subscribers now, and I anticipate hitting 1,000 subscribers. I really don't know when. It's kind of hard to put a time frame on that stuff. But I'm going to keep cranking out videos, guys. I love what I've done with the channel, And I love the support from you guys. I read all the comments. And like I said, and like I always say, I'll see you next Monday. Let's build wealth, guys.